Is there somebody who can remind us? How do we get this PE ratio? PE ratio from Josephine. Josephine gave us the earlier formula from Ambrose, MPS over EPS. I can see Mary, MP. Very good. What they are telling me is that we know how to get this PE ratio. It is MPS over EPS. So that I can come very comfortably here and say that, ladies and gentlemen, this one, if I was to expand this in full, it will be MPS of predator. MPS of predator all over EPS of predator again. EPS of predator times EPS here times EPS of target company. Now the question is there somebody who is able to see the MPS from that particular table? There are good students who remember the formulas, but most of them are not able to pick proper values from our tables. Is there somebody from that particular table? Is there somebody who is able to show us, to give us the formula? Not formula, but the MPS. I want the MPS of company A. Predator is company A. MPS of company A. Somebody, are they able to pick that figure very well? MPS of company A. 60. MPS of company A, they're right. It is 60 more. How about EPS of company A, the predator? EPS of company A, EPS of company A. EPS of company A. Already I've seen it, but I want students to give me the figure. 4. Most of them are able to see 4. Multiplied by EPS of the targeted company. 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 Is there someone who is able to see the EPS of the targeted company? Yeah, Ambrose again. I can see Grace 3. Thank you very much. So then at the end of the day, what do we have as the non-diluting offer price? What we normally call the famous NOP. Non-diluting offer price, ladies and gentlemen, will be equal to what parameter there? 45 is coming from Shayla. 45 is coming from Shayla. Thank you very much. 45. Remember, this examiner never wanted us to ascertain the non-diluting offer price. This is just an obiter dicta. It's a by the way. A by the way. The major thing that this person wanted us to compute is the premium. The premium. So who is able to remind us again the formula of getting the premium? Somebody, write for us the formula there as we wait for the other students to join us. You can see now we are short of about 20 students. They must be taking perhaps their dinner. So I'm waiting to get that student who will be able to remember the formula of the premium. How do we get the premium? Very good. I can see students like Christine is giving us offer price. Offer price. Thank you very much. The premium here, I'm being given a very good figure by very many students that for us to be able to get the premium of company B, shareholders, company B's shareholders, we should take the offer price that you guys have calculated. The offer price that you have calculated minus MPS of the targeted company. Offer price minus MPS of the targeted company. So the offer price, ladies and gentlemen, the offer price is supposed to be what? The offer price from the table given, or rather not the table, from the figure we got up there, the offer price was 40 what? 45. And unless we are wrong, the offer price, we got a figure of 45. Minus the MPS of the targeted company. Is there somebody who is able to see the MPS of the targeted company? Could you kindly give me that MPS of the targeted company from the past paper? From somebody who has a past paper, MPS of the targeted company, is it supposed to be 3 or 30? MPS of the targeted company from the past paper is supposed to be 30, not 3. 30. So 45 minus 30 gives us, in this case here, 15. But what do you think, ladies and gentlemen? Is this really the premium that this examiner wants us to ascertain? Are we going to do anything more? Or we are comfortable with this figure? Are we able to do anything extra here? Or we simply say we have completed, we go to the next question. Are we going to do anything? Are we going to do anything more? Anything more? Very good. The students are able to recall this very fast. That for us to be able to get the total premium, what we need to do is to come and take the 15 times the nose of the targeted company, times the nose of the targeted company. So 15 times the number of ordinary shares of the targeted company. Why are we doing this multiplication? It's because 15, ladies and gentlemen, 15 is premium per share. Premium per share. So, ladies and gentlemen, come and take the number of ordinary shares of the targeted company. That's company B. Company B from the table. Company B from the table. What do we have there? Company B from the table. Outstanding number of ordinary shares in millions. Company B, I can see 3. So it will be 50 times 3, which gives us 45 what here? Million as our total premium. As our total premium. I'm so sure everyone here would have gotten that correctly in an exam. Let's look at Roman 3. If you allow me, please let's look at Roman 3. Roman 3, A Limited's post-acquisition EPS, assuming that the two companies agree on an offer price of shillings 30. A Limited's post-acquisition EPS, assuming that the two companies agree on an offer price of shillings 30. So this post-acquisition EPS, who remembers the formula? Formula of getting post-acquisition EPS. Formula of getting post-acquisition EPS. Who remembers that formula? Somebody check in the comments there. Check in the comments there. Check in the comments there. Who remembers the formula of post-acquisition after marriage? After marriage. After marriage. After marriage. After marriage. We spoke about something after marriage. Combined net income divided by the total number of shares. We have this student has given us a very good way. Gross earnings 1 plus earnings 2 divided by, very good. We had a late login awareness. Please repeat Roman 1 and 2. Josephine, E1 plus E2, very good, very good. Very good, Veronica, very good. What they're telling us, ladies and gentlemen, is that for us to be able to get the post-acquisition earnings, post-acquisition EPS, post-acquisition EPS, you should take the earnings of the first company plus earnings of the second company. And then you divide by number of shares. Number of shares of company 1, nose 1, plus nose 2. Of course, nose 2 has always to be multiplied with what here? Exchange ratio. Has to be multiplied with the exchange ratio, nose 2. Nose means what here, somebody? Number of ordinary shares. Nose means number of ordinary shares. EI means what here? The total earnings. Total earnings, profit after tax. The net income. The net income. And then we have this ER, ladies and gentlemen, standing for exchange ratio. Standing for exchange ratio. In this particular situation that we are in, can somebody give me the formula of the exchange ratio that will be applicable? The formula of exchange ratio that will be applicable. That will be applicable. The formula of exchange ratio that will be applicable. Remember now here we are not calculating maximum exchange ratio. We are not calculating what we call an undiluting exchange ratio. Here we are calculating the normal exchange ratio because the offer price has been given. Because the offer price has been given. Somebody check in the comments there. Is there somebody who has been able to give us the formula? From Dan, we have offer price divided by MPS of the creditor. We have Mary offer price. Thank you very much. Veronica offer price divided by MPS of the creditor. We have Techno. This student has come in using her or his phone. We forgive her or him. Next time I know they'll come using their names. So offer price Offer price. So very good. So the normal exchange ratio will be equal to the offer price all over the MPS of the predator. Thank you very much. Offer price all over the MPS of the predator. So what is the offer price? In this particular question, this examiner has specified the offer price. If you look at the question given there, ladies and gentlemen, you'll be able to see the offer price. The offer price. If you look at the question given, you'll be able to see the offer price in Roman 3. We're given, they have agreed on an offer price of 30, all over MPS of the predator. Go back to that table up there, you'll be able to see the market price per share of the predator, which is what here? 60. So 30 over 60 gives me a half. 30 over 60 gives me a half. So please come and plug in the figures in this formula. So give us earnings of company 1. From the question given, I'm able to see the net income of company 1 is 40. Company 1 is A. So the net income of company 1 is 40 plus net income of company 2. Net income of company 2, ladies and gentlemen, I can see a figure of 9. Everything to be divided by number of ordinary shares of company 1. Number of ordinary shares of company 1, I can see there are 10. 10 plus number of shares of ordinary shares of company 2. Ordinary shares of company 2, which I can see there are 3. Multiplied by the exchange ratio that you got a half there. Most of the students, as you were marking this particular sitting, most of the students picked the exchange ratio that they got in Roman 1. That exchange ratio they got in Roman 1, the 3/4. Most of them. And of course, that was a sure way of derailing from the road, going towards passing. They were in this case here thrown by the examiner into the forest. Whenever you are given an offer price, I'm repeating this again. Whenever you are given an offer price, you must compute a new exchange ratio. So please, body mass. I saw people calling Ambrose body mass. I don't know, for whatever reason, Ambrose is called Mr. Body mass. So this body mass, numerator is 49. Then the denominator will be 10 plus 3 divided by 2, which gives me 11.5. Then the final answer will be 49 divided by answer, which gives me 4.26, shillings per share. Very good. Now we got the last area, ladies and gentlemen, the last area. What are we told in the last question? Roman 4. A Limited's post-acquisition EPS. Assuming that for every 100 ordinary shares of B Limited, the shareholders are offered 2 12% debentures of shillings 500 per value. So, ladies and gentlemen, this is a loan acquisition. This is an acquisition through what? A loan. A loan acquisition. If it is a loan acquisition, there is something that I will be able to remember very fast. That the exchange ratio will be equal to what here, somebody? Will be equal to 0. Exchange ratio will be equal to 0. Remember, whenever an acquisition is done by issuance of a loan, a debenture instrument, or through preference shares, if you also give preference shares, then the exchange ratio automatically will be 0. This is something that we need to write somewhere down there in our mother tongue. What have we said? That the exchange ratio is always equal to 0 whenever acquisition is through either a loan or a preference share. Exchange ratio is only applicable whenever the exchange between the two companies is in terms of ordinary shares. One company giving its ordinary shares, the other company giving its own ordinary shares. But whenever you have like one company giving ordinary shares, but in return the other one is giving, for example, a loan, in return the other one is giving preference shares, then there is nothing like exchange ratio there. There's nothing like exchange ratio there. Now, read the question again. Let's read the question again. Let's read this question again. Let's read the question again. Ladies and gentlemen, we are told A Limited's post-acquisition EPS. Post-acquisition EPS is what they want us to give them. Post-acquisition EPS. So could you kindly write this formula for us? Post-acquisition EPS. Anytime I hear of this post-acquisition EPS, once I've acquired you as my spouse, if we are a good couple, then automatically my earnings and your earnings in this case here should be put together. And of course, even in a joint account, and of course you trust your husband 100% to be the only one who can access the money, right? So we have earnings of company 1 plus earnings of company 2 divided by number of ordinary shares of company 1 plus number of ordinary shares of company what? 2. And remember that ordinary shares of company 2 must always be multiplied with what here? Exchange ratio. Here there is something funny. That because we have a loan involved, our total earnings must reduce. Our total earnings must go down. So they come and they say minus interest. And remember, interest is normally what here? Tax allowable. Remember, this is net income, which is profit after tax. So even the interest has to be after tax, because the interest are tax allowable. If it were preference dividend, here we don't subtract taxation. Because any form of dividend can never be allowed for taxation purposes. So then what a good student will endeavor to do very first is to give us the interest amount, of which I would want to give you 1 minute to try giving me the amount of interest which you shall pay. Please let us take them back to the question. Okay. So I want a good student to be able, ladies and gentlemen, to give us the total interest. How do we do this? They have told us A Limited's post-acquisition EPS, assuming that for every 100 ordinary shares, for every 100 ordinary shares, we shall be given 12% debentures. So we shall be given 2 debentures, and each is worth 500. So then, ladies and gentlemen, this will be the same as saying ordinary shares, 100 ordinary shares, we shall be given 1,000 bob. And how many shares are we going to buy? How many shares will we be receiving from this targeted company? The targeted company, ladies and gentlemen, from the question, the targeted company has how many shares there? 3 million shares. The targeted, they want to be acquired. They want to be acquired fully as 3 million shares. Then if you cross multiply, how much are we going to give out? How much in form of a loan are we going to give out? How much in form of a loan are we going to give out? So it will be, we have here 1,000 times 3 million divided by 100. So if you use your calculator very well here, you'll be able to see that at the end of the day, we need to give 30 million Kenya shillings in form of a loan. But you see, what we want here is the interest. So come and give us the interest. Have they given us the coupon rate? Oh yes, they have told us the coupon rate is 12%. The coupon rate of interest is 12%. 12% of the total loan, which is 30 million. 12% of the total loan, which is 30 million. So come and punch there. 12% is the same as 0.12. 12% is the same as 0.12. So we have 0.12 times 30, giving us 3.what here? 3.6. 3.6. So therefore, the post-acquisition EPS will be equal to earnings of company one. Earnings of company one, that is the same as net income. The net income of company one there is 40. The net income is 40. Plus, we have the net income of company two, which is 9. 9. Minus the interest in form of millions, 3.6. 3.6 times 1 minus the rate. If you go back to the question, the rate of tax. Yes, they've told us before required that both companies are in the 30% income tax bracket. So then 1 minus 0.3 gives us what here? Somebody gives us 0.7. 1 minus 0.3 gives us 0.7. Divided by the number of ordinary shares. Number of ordinary shares, what do we have here for company one? Number of ordinary shares for company one, which is company A, we have 10. 10 plus number of shares of company two. Number of shares of company two, ladies and gentlemen, there are 3. Multiplied by the exchange ratio, which will be exactly equal to what here? 0. Which will be exactly equal to 0. Why 0? Because we started by saying that whenever there is a loan involved in acquisition, the exchange ratio is always 0. You can even cram it that way, that whenever there is a loan being involved in the acquisition exercise, the exchange ratio will be exactly equal to what here? 0. Then could you kindly give me the final answer here? So that's 49 minus answer times 0.7 equals divide by 10. Is there somebody who is able to get 4.6? Is there somebody who is able to get 4.648? 4.648. I would want to see whether there is anybody who has been able to give us 4.648. 4.648. Is there somebody who is able to get that kind of a figure? Thank you very much. I can see Munyao. Munyao Cosmos is quite fast. Okay. The students who are not able to see the question, the board and the question, if you want to see the board, there is a small video down there. You are playing around between two things. The video down there and then the handout. So you keep on interchanging. You keep on interchanging. You simply press 1. Simply press 1 and you move. Now, my great students, I don't know whether there is anybody who has a question regarding what you have done. Regarding what you have done. Otherwise, my work tonight is to help ourselves here understand this concept of what here? Dividend irrelevance. Dividend irrelevance. Dividend irrelevance. Modigliani and Miller, dividend irrelevance theory. Dividend irrelevance theory. Modigliani and Miller, dividend irrelevance theory. Dividend irrelevance theory. Modigliani and Miller. Modigliani and Miller. And Miller. Dividend irrelevance. Dividend irrelevance. Irrelevance. Dividend irrelevance theory. Dividend irrelevance theory. Now, ladies and gentlemen, in section 3, you did quite a lot of theories on this dividend policy. One of the theories that you did in section 3 very well was the theory that is called the bird in hand theory. Yule ndege mnyama ambayo uko nayo kwa mkono ni afadhali zaidi kuliko wawili watatu ambao wako kwa kichaka. The bird in hand theory. That if you are handling a company where most of the investors are poor people, when it comes at the end of the year, the poor people will tell you, oh no, we don't want to hear about your good stories about future investments to give us capital gains in the future. No, We want our dividend today. So you go and tell them that, ladies and gentlemen, in the AGM, we have our earnings per share being equal to 10. And then because now we have got some expansionary ideas, we want to expand in the future, we want to retain 80%. And then we give you what here? 2. If we retain 80% of 10, then the company is retaining 8 and giving out shillings 2 as the dividend per share. Now, ladies and gentlemen, on just mentioning like that, I can see 2 things happening. Number 1, there will be some shareholders who will jump even on top of some tables there, making a lot of noise. Why? Because they can't see any reason why we should retain most of their money. And then number 2, in that AGM, if you make this kind of a mistake and make this kind of a declaration, chances are in that AGM, ladies and gentlemen, that AGM, some directors will be voted out. Why? Because most of our investors are not well-to-do. Most of them believe that the bad that they have today is what is most important. But now remember, on the background of this, with this insight, Modigliani and Miller went ahead and did a very good research where they were able to tell us, to tell other scholars, and of course their followers, that at the end of the day, if you get this 10 and you decide to pay dividend over 10, everything, or in this case here you decide to retain 10. So 2 scenarios, you pay everything or you retain everything. At the end of the day, the argument was that the value of the farm will be the same. The value of the farm will be the same. And if you remember this theory very well, they went ahead and told us that when you pay a lot of dividends outside there is what we call the market signaling hypothesis. That once you are paying very high levels of dividends, the market outside there has got a way of knowing that this company is paying very well. So what will happen is that the dividend, or rather the shares of the company, will have a huge demand. And once we have a huge demand, our shares being demanded highly outside there, automatically will have the market value going up. They said, fine, giving dividends will signal good things to the market. And as such, we expect the market price per ordinary share to go up. But they came and they said, ladies and gentlemen, even if you were to pay 0, and this money is reinvested back, you pay 0, you retain everything, and then the money is reinvested back in this particular fund. The market outside there, of course, will not have very many good things to talk about us. They'll even shy away from our shares. But according to Modigliani and Miller and the dividend irrelevance theory, they say that even if our shares outside there don't have much demand, whatever we'll do with these retained earnings will ensure that we will get what we call a capital appreciation, a capital gain. Now, ladies and gentlemen, the most important thing is for you to know here. That anytime we are talking of Modigliani and Miller, dividend irrelevance theory, the value of a firm that pays dividends will always be equal to the value of the same firm which does not pay dividends. For us to be able to understand what we're talking about, let's look at last semester's paper. There is a question that came last semester. Just scroll a bit there. There's a question which came last semester. Last semester. Last semester, that is there somebody who is able to see that question? Scroll again. So last semester, Last semester's exam was a very easy one, very easy one. You can see they brought this concept of beta over equity over geared firm. They brought portfolio there. They brought real estate. They brought this concept of bond refinancing, which we'll be doing today. Yeah, it is here. It's question number 5C. Question number 5C. Question number 5C. Go to question number 5C. Question number 5C. Question number 5C of last semester. Question number 5C of last semester. Question number 5C of last semester. It's a simple concept that you guys did in section 3. They're talking about Trigger Limited. Trigger Limited has 500,000 ordinary shares trading at shillings 150 each in the securities exchange. So they're trading for how much? 150 each in the securities exchange. Additional information, the dividend payable in 1 year's period is shillings 3, not 2. Not 2. An investment opportunity worth shillings 25 million is to be undertaken. I'm reading not 2. We are told that the profit to be earned is shillings 15 million. Lastly, the cost of capital for the company is 10% required. Using Modigliani and the Miller approach, show that the payment of dividends does not affect the value of the firm. Whether you pay or not, the value of the firm will be the same. The value of the firm will be the same. The value of the firm will be the same. Modigliani and the Miller, dividend irrelevance theory. Now, ladies and gentlemen, if you can recall from your section 3, this is a topic in section 3. If you can recall from your section 3, ladies and gentlemen, we used to do this work with this very small but important formula, We used to say that amount should be equal to principal into what year? 1 plus R. Amount should be equal to principal into 1 plus what year? R. Of course, here we are talking of the end of the year, so our n is 1. Yes. So remember, principal to us is the present what? Is the present value. Principal to us here is the present value. And the present value, in terms of shares, our principal should be equal to, or rather should be PO. So come and talk about here that amount equals PO into 1 plus what here? 1 plus R. Very important formula. But you see, ladies and gentlemen, if you have been invested in a security, at the end of the year, what are you going to get? At the end of the year, what are you going to get? You're going to get 2 things. This amount here basically has got 2 components. You're going to get the expected dividends, and you're going to get, in this case here, your shares price if you sell. So you're going to get D1 plus what here? P1. D1 plus P1. At the end of the year, I'll be getting 2 things. My dividend. These guys have traded with my money the whole year. So I expect my dividend, D1. And then number 2, ladies and gentlemen, if you're going to sell our share at the end of the year, we are going to realize what we call P1. What we call P1. So ladies and gentlemen, D1 plus P1, the 2 here represents what here? Our amount, which will be equal to PO into 1 plus what here? 1 plus R. 1 plus R. So we are learning a very important formula. Very important formula under MM, dividend irrelevance theory. Under MM dividend, the moment you mention MM, dividend irrelevance theory, I will always remember this formula, that the amount I will receive by the end of the year will be equal to my share price, current share price, which of course will be compounded, So will you kindly write this formula under DIRELM, dividend irrelevance theory, this formula is very important, and if possible, it's a highlighter. I see a highlighter a bluish, yellow. Yellow highlighter is the only highlighter which works very well. I'll tell you one day why I love this yellow highlighter. I'll tell you one day, not today. Not today. Thank you very much. You have written it and you've been able to highlight it. This is very good. Now, ladies and gentlemen, remember now what are we supposed to do? If you can recall, the very first thing you were going to do is to determine P1 under both scenarios. You determine P1 under both scenarios. I.e., number one, if we pay dividends, if we pay dividends, what will be the value of P1? If we pay dividends, what will be the value of P1? If we are to pay dividends, what will be the value of P1? Two scenarios, remember. Number one, if we pay dividends. Scenario number two, if we don't pay dividends, what amount of P1 shall we get? What amount of P1 shall we get? So the first scenario is if we pay dividends. So the question will be, if we decide to pay dividends from note number three, if we decide to pay dividends, ladies and gentlemen, from note number three, how much dividends are we going to pay? From not three, it's note number one. The dividend payable in 1 year's period is 3. So if we decide to pay dividends, we are going to pay 3 shillings at the end of the year. And if I use this formula of mine, my D1 here is 3 plus P1 that we don't know, which will be equal to PO. PO stands for what? The current market price per share. PO stands for the current market price per share. Has this examiner given us the current market price per share? Has this examiner given us the current market price per share? Has this examiner given us the current market price per share? Oh yes. In up there before the additional information, they told us Trigger Limited has 500,000 ordinary shares trading at 150 each in the securities exchange. So trading means what? Continuing. So the current price. I hope you've written somewhere there that PO stands for the current price, which you guys have given me a figure of what here? 150 into 1 plus R is the required rate of return. The required rate of return is the same as the cost of capital. And in this question, for sure, they have given us the cost of capital. In this question, they have given us the cost of capital. What is the cost of capital in note number 3? In note number 3, the cost of capital for the company is 10%. The cost of capital is 10%. So here we have 0.1. So could you kindly give me P1? The moment I remember this formula, anytime they talk about dividend irrelevance theory, I always remember the high school formula, amount equals PO into 1 plus I. And then this amount, what amount am I expecting? I'm expecting D1. I'm expecting my price to come back, but of course not in the same way, not the same amount. It has to be an expected price. So I'm expecting D1 and the P1 to be paid at the end of the year, which will be equivalent to the capital appreciation of P0. P0. So ladies and gentlemen, if I was to make this the subject of the formula, it will be 3 plus P1 equals, this is 1.1. And the 1.1 times 150, if I take here 150 times 1.1, I will end up getting 165. I'll end up getting 165. And therefore, my P1 will be equal to 165 minus 3, which gives us 162, which gives us 162. This is the first scenario. If we pay dividends, 162 will be the price per share at the end of the year. That is scenario 1. How about scenario 2? What if we do not pay dividends? These are free marks I'm getting even before I start doing the question. What if we don't pay dividends? So scenario 2. Scenario 2. If we don't pay dividends. Scenario 2. If we don't pay dividends. Scenario two, if we don't pay dividends. Scenario number two is if we do not pay dividends, meaning that i.e. if our D1 is 0, then what will be the P1? What will be the P1? What will be the P1? So long as I master that formula of MM, dividend irrelevance, so long as I master that formula, I'm at home. I'm at home. I'm at home. So, ladies and gentlemen, we have here our D1 plus our P1 should be equal to what on the other side of the coin? Should be equal to PO into 1 plus R. D1 this time around you've given me a figure of 0. P1 is what we are looking for. PO remains the same. The shares are currently trading at 150 into, we have 1 plus the firm's cost of capital, which is 0.1. Then my P1, ladies and gentlemen, here will end up being what here? 100, and I have to use my calculator. So we have 150 times 1.1, which gives us 160 what? 165. 165. So, ladies and gentlemen, pertaining this question, assuming you was to stop there, pertaining this question, assuming you were to stop there, where we have reached, what will be your take home? What will you never forget about this question? Could you kindly write for me in the comments there? What will you never forget in this type of a question, assuming you were to stop there? What will you never forget? I'm waiting in the comments there. What is your take home, assuming you were to stop there for this question? For this question, yes. Most of them are not writing anything. Most of them are saying nothing. We have not even. Very good. I can see from Munyao. Munyao has been able to master the formula. D1 plus P1. Dividend irrelevance theory. D1 plus P1 will always be equal to PO into 1 plus R. I want us to master this question because it was a small question, but it was very poorly done last semester, this one. And of course, as you know, CASNEP, questions that are normally poorly done, like you had from the webinar, which are normally poorly done, in the subsequent sittings, these guys would want to see whether those areas have been taught well by the respective teachers. So what do? They will end up, of course, testing the same areas, but they twist them a little bit. So they take home, whether you pay dividends or not from Mary, the value of the firm remains the same. I like that. Dividends are irrelevant. If no dividend, then P1, from Christine, she has been able to come up with something also very nice there. Thank you very much. What is the name here? This name is Rikiza or Rikita. Can't see the name very well. Okay, very good. Thank you very much. Now, ladies and gentlemen, having done that, what I need to do is to come and now make my 2 columns. Make my 2 columns very well. So the first one here, I'll come and talk of pay dividends. Pay dividends. Here we have don't pay dividends. Don't pay dividends. Don't pay dividends. Don't pay dividends. So 3 things. I will start with the expected price. The expected price, what we call P1. P1. If we decide to pay dividends, ladies and gentlemen, what is the P1 that we got up there? If we decide to pay dividends, what is the P1 that we got up there? If we decide to pay dividends, we got some P1 up there, 162. How about P1 if we say, as a firm, we are not going to pay dividends? If we say, as a firm, we are not going to pay dividends, what is the price? 165. Thank you very much. Now, from there, ladies and gentlemen, I would want to know the profits. Are you able to see the profits of the firm? Profits. Are you able to see the profits of the firm? The profits of this organization, how much profits have they made? Please look at note number 2. Note number 2, note number 2. What do we have there in note number 2? I hope you have that particular question with you. Note number 2, they have given us the profit earned is 15 million. Either way, so profit here is 15 million. Profit is 15 million, doesn't matter. Now, ladies and gentlemen, out of these profits, I'm interested in the retained earnings. Out of these profits, we're going to pay dividends, but most importantly, I want the retained earnings. I want the retained earnings. So could you kindly come here and less the dividends? So less the dividends, less the dividends. Could you kindly give me the first scenario's dividends? Total dividends. Total dividends. The first scenarios, total dividends paid. Is there somebody who has a figure there for us? $1.5 million, because that student has been able to make reference up there. First of all, the student knows that the dividend per share is 3. And then the total number of shares we have there currently are what here? 500,000. So 3 times 500,000, you're right, gives us 1.what here? 1.5 million. So please subtract there to give me retained earnings. To give me retained earnings. Subtract there to give me retained what here? Earnings. To give me retained earnings. So 15 million minus 1.5 gives us what here? 13.5 million, thank you very much. 13.5 million, thank you very much. I'll come and double underline this figure. This is a very important figure for me. Go to the second scenario. Second scenario, could you kindly give me the total dividends here? Give me the total dividends. Second scenario, give me the total dividends to be paid that year. 0, because you're the ones who have told me don't pay dividends. So if you take 0 times 500,000, it's 0. So less dividends, 0. So in this particular year, we are able to retain everything. So we have here retained earnings of what here? 15 million. That is step number 2. Step number 2. Step number 2. From there, ladies and gentlemen, you go to the financing projects. So mention their projects. Step number 3, you go to the projects. The projects that we happen to be having, ladies and gentlemen, the projects that we happen to be having, needs how much? The project. If you look at this particular question, we must be having an investment opportunity. The project that we have there needs 25 million. So the project here, the investment is 25 million. The same case with this other second scenario. The project, you go to the project always. So the project here is 25 million. Of course, ladies and gentlemen, for projects here, we are looking at how do we finance these projects. If you remember Miller, financing of projects, we normally finance projects using only equity. Under equity, we have retained earnings and ordinary share capital. And first, we utilize the cheaper source of finance, which is retained earnings. So come and tell us here, less retained earnings. Less retained earnings. We less retained earnings. Retained earnings, of which the first one, you guys gave me 13,500. Like that. And then here as well, you less retained earnings, which you guys were able to give me as 15 million. So from there now you will come and give us what we call external finances. External finance in the name of ordinary share capital. External finance in the name of ordinary share capital. Remember, under Modigliani, Miller, dividend irrelevance, we normally finance our projects using retained earnings and ordinary share capital. Equity basically, equity only. Equity. So somebody give me this figure, 25 million minus 13.5 gives me what here, somebody? So the first one, I would say, is giving me a figure of 11.5 million. 11.5 million. So please go to the second one and they give us the external finance. External finance, 10 million, eh? External finance, 10 million. Now, having got an external finance, I need the number of ordinary shares, the nodes. I need the nodes, number of ordinary shares. So number of ordinary shares, what do? You will divide this by the market price per share. So come here and divide this by P1. The same case here, you divide this by P1 for you to be able to give me these nodes. You divide by P1 for you to be able to give us the nodes. You divide by P1. Remember, you have the P1s. You take this figure you have, you divide by 162. Give us a figure, if possible, like 3 decimal places, 3 or 4 decimal places. So 11,500,000 divided by 162. What are we going to get, my brothers and my sisters? I'm waiting to get answers from you. Give us a figure. 70,000. 987.654. 0.654. Thank you very much. 0.654. 0.654. How about the nodes of the second option? You take 10 million divided by P1 there, which was 165. No stands for what in full? Number of ordinary shares. Number of ordinary shares. No's in full stands for number of ordinary shares. Number of ordinary shares. So is there somebody who is able to give us the no's here? 60? 606. 606. Oh, 60,000. 606. Point 061. Thank you very much. Thank you very much. Thank you very much. Now from there we go to the last lap for us to complete our journey. We go to the last lap for us to complete our journey, the one of farm valuation. So you mentioned there farm valuation. Farm valuation. Farm valuation at the end of the year. 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 So farm valuation at the end of the year, what do we have there? It's very easy to get this farm value. So farm value at the end of the year. Normally what you do, ladies and gentlemen, you will give us the total number of shares. You give us the shares value. The shares value. The shares value, remember, ladies and gentlemen, for these paid dividends, the shares value will be, for the ordinary dividends, we have here farm value. So the shares value will be 70,987.654. But remember, we had all the shares. The old shares which we had, ladies and gentlemen, if you recall, in this question, the old shares we had were 500,000. 500,000. But now remember that we are valuing this at the end of the year. We are valuing this at the end of the year, and we happen to be knowing the market price per share at the end of the year if we are going to pay dividends. So you're the guys who gave me a figure of what here, somebody 162. You're the people who gave me a figure of 162. 162. So you take the total number of shares, new and old, as at the end of the year, So times 162 plus the profit which we shall realize at the end of the year. If you look at this question very well, this examiner has given you the profit. The profit which you expect to make, if you read this question very well, you can just throw it somewhere there. If you read this question very well, the profit which is given in note number 2, the profit to be earned is 15 million. The profit to be earned is 15 million. 15 million. The profit to be earned is 15 million. 15 million. 15 million. And then, of course, if you can recall very well, this gives us the total equity. Ordinary shares plus profit. Ordinary shares here plus the profit. And then, of course, you will come and subtract the total investment. You subtract the total investment. What is the total investment we expect? The total project value. You gave me a figure of 25 million. So minus 25 million. I'll explain why we are subtracting this, but for now, you will come and divide this by 1 plus R. You discount. So you divide this by 1 plus what here R? R, which is 0.1. Ladies and gentlemen, I want to repeat this. That for us to be able to get farm value, normally, you take the new shares plus the old members' shares. The old member shares. You come and multiply this by P1. You multiply this by P1 plus the profit of the farm. Profit. Pi stands for profit. Pi stands for profit. Minus the investment. You subtract here the investment. And then everything to be divided by 1 plus R. Everything to be divided by 1 plus R. I'm repeating again. But anytime you want to get farm value using dividend irrelevance, you will take the new shares which you have computed, plus the old members' shares, 500,000, times P1, plus this pi stands for profit, minus the investment, all over 1 plus R. All over 1 plus R. I'll explain why we are subtracting the investment, but for now, could you kindly give me the final answer here? Give me the final answer here, somebody. Give me the final answer. Somebody who is very good at body mass. Somebody who is very good at body mass. Give us the final answer. Give us the final answer. 75 million. Who gave me that answer? Eva. Eva Josam. Eva then Josam. Thank you very much. I have 75 million. Quite interesting. All of them are getting now 75 million. Eh? Ambrose has also gotten 75 million. But those are only 3 students. Yes? Bianca. Christina has 75 million. Thank you very much. Thank you very much. At least we are moving together. Thank you very much. Now, I would want a good student to come and apply the same formula on this other side of the coin, where we are not paying dividends. Don't pay dividends. Don't pay dividends. If we don't pay dividends, could you kindly do farm valuation for us, and then we provide a present? We need to give presents at times. We are not supposed to be very mean. Let us not be very mean. We're supposed to be giving presents at times. Oh, they're saying that every time we do screen sharing, it messes the network. Maybe it's something we need to check. Okay. Check whether they've gotten the answer. Check whether they've gotten the answer. Is there anyone who has been able to give us the answer for both of them? So seemingly, many students are able to get 75 million, right? $74,999. So you round off to 75 million, isn't it? You round that off to 75 million. Maureen, has Maureen been able to get a solution? Maureen, student number 226. Agnes. Munyawa, have you gotten 75 million? Kennedy 101. Munyawa has rounded off. Thank you very much. Bernard Kirui. $75 from Grace. Thank you very much. I'm waiting for Bernard. I'm waiting for Bernard. Abdia, great. Great. Great, 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 great. Sheila. Mercy 46A. Mercy 46A, what is your answer? Okay, thank you very much. So 75 million equals 75 million. So I want to believe that that is very, very okay. So then if for paying dividends, you're getting 75 million, and I don't pay dividends, you're getting exactly what? Yes, 75 million. What does it mean? That whether you pay dividends or you don't pay dividends, at the end of the day, the value of the farm is what here is the same. The value of the farm 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 is the same. For not paying dividends, remember, for not paying dividends, what do we have? If we don't pay dividends, so farm value, when we don't pay dividends, don't pay dividends. Farm value for not paying dividends, what do we have? We have our new shares. Our new shares have grabbed my figure. What were our new shares here equal to, somebody? The number of new shares ilikuwa ngapi? If we don't pay dividends, somebody read for us. If we don't pay dividends, number of new shares ilikuwa ngapi? 606.061 plus the old members' dividends, old member shares, 500,000. Multiply this by P1. P1, which was 165. P1, which was 165. 165. Plus, ladies and gentlemen, the profit, which will be 15 million, minus the investment of 25 million, like that. And then whatever we get, we shall come and discount by the same factor, 0.1, like that, which will be 74.99, which is the same as what here, 75 million, which is 75 million. 75 million. Ladies and gentlemen, for dividend irrelevance, according to these people, what they discovered is that whether you pay dividends or you don't pay dividends, values of the farm will always be what here, will always be the same. Will always be the same. Where are we subtracting this investment? When getting value of the farm, ladies and gentlemen, remember, in the short term, when you go for these PPEs, if you buy this PPE like today, it's like you have knocked the value of the farm to even negative. You can only start enjoying the value of your PPE upon what year? This PPE, property, plant, and equipment, staying with it for some time in the future. So this is a long-term investment, or rather you're going to gain in the long term, but in the short term, that cash flow has to be reduced. The very best thing is for you to cram the formula. Now, as I go to something different, ladies and gentlemen, if you are asked here a question on this dividend irrelevance theory, from what you've been able to tackle with you, what are you able to recall very fast? Ladies and gentlemen, regarding this dividend irrelevance theory, Modigliani and Miller? What are those things that you can never forget about this? Any three things that you can't forget, even if it's just the steps, without making reference to your notes. Those three things that you cannot forget about dividend irrelevance theory. In the comment section. The formula, have you been able to quote them down there? Pay or don't pay dividends, the farm value will be the same. Farm value will be the same. I like that. Farm value will be the same. I like that. D1 plus P1 equals, I like that. Retained earnings is cheaper. From Bianca. That's very good. You have to discount. That is very good. Pay or don't pay from Aurelia, the farm value will be the same. D1 plus P1 from Mercy equals PO into 1 plus R. Pay or don't pay. So farm project is financed through equity alone. Thank you very much. So that is something I would want you to go and repeat. Please ensure that you repeat very well. So I would want you to mention there bond refinancing. Title, bond refinancing. Bond refinancing. Title, bond refinancing. And this bond refinancing question, I will not display the question. I would want us to do this question of last sitting that came. Last sitting question, which I not display. So please get your past paper. Because the students who are telling us that when we display, they lose the network. They lose the network, which is quite unfortunate. So please get your own past paper. Get your own past paper. And then we look at question number 4. Question number 4C. Question number 4C. Question number 4C. Question number 4C. So I would want to know whether they have their past papers with them. Bond refinancing. Bond refinancing. Bond refinancing, November 2019. Question number 4C. November 2019. Do they have their past papers? They want us to display. When we display, they are telling us that they lose the network. Display are so many, eh? So just display, but we'll now move slowly. Display. Okay. So Faith will have to forgive us, eh? It's this one. Smooth. Now, ladies and gentlemen, I would want you to understand this very well. Like just the other day, our great government issued Eurobonds to like 3 countries, investors in 3 countries. So the very first Eurobond that we issued was a little bit expensive. The first Eurobond that we issued, ladies and gentlemen, averagely was costing our government about 7%. About 7%. Later on, we were able to get other investors who are willing to give us money at a lower rate. So look at this. If we could just show them the board here. Assuming the Kenya government at first, the Eurobond was to run for how many years? Was to run for 10 years. Was to run for 10 years, ladies and gentlemen. And then in between here, this is the bond of 7%. In between years, time progresses by. We hit half the period here. And then we get some investor who is telling us that we can easily give you the same equivalent money, but at say what year? At 4%. So what we shall do is to ask this gentleman to finance, to give us a loan, to take this particular bond, so that the moment we get this money, what we shall do is to retire. We chase away this expensive what year person who gave us the money, this expensive investor, we chase him away. So we are refinancing bonds. We are getting away of creating a way of raising money to pay off expensive debt. That's what we call bond refinancing. For us to understand this, we have a question with us here, which I've displayed. A question with us that we have displayed here. It's called a Smooth Drive Limited. Smooth Drive Limited, a motor vehicle assembly company, issued, I have to underline that, a 10-year, 16%, shillings 100 par value bond. How many years ago? 5 years ago. So the bond is 10 years. So 5 years have elapsed. So now we have only 5 years to go. The bond was issued at 2% discount, and the issuing costs amounted to shillings 2 million. Due to the decline in treasury bill rates in the recent past, interest rates in the money market have been falling. presenting favorable opportunities for refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings 100 million par value, 12%, you can see 12% is cheaper as compared to the 16%. 5-year bond could be issued by the company. Issuing cost for the new bond will be 5% of the par value, and a discount of 3% will have to be given to attract investors. The old bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid on redemption. All bond issue expenses, including the interest penalty, are amortized on a straight line basis over the life of the bond and are allowed for corporate tax purposes. The applicable corporate tax is 40%, and the after-tax cost of debt to the company is approximately 7%. So what do they want us to do? They want us, ladies and gentlemen, to give them the initial investment required to issue the new bond. So when you want to issue this new bond for purposes of raising money, which we shall use to pay the old bondholders who are seemingly very expensive. So for us to issue this new bond like this, what amount do we need? What amount do we need? So could you kindly get us started? Part 1, the initial investment required to issue the new bond. That is your question. That's a very easy question. That's a very easy question. I'm giving you a minute. Try to think, ladies and gentlemen, what do we need for us to be able to, what do we need? How much do we need as an organization to enable us attract, to enable us get this new money? Very easy. So mention there cash investment, or the initial outlay, cash investment, or the initial outlay, cash investment, or the initial what year outlay, or the initial outlay. If you recall, if I've ever taught you this, these are things that you can even come. You simply come and give us this acronym, CODI like that. CODI. So CODI, the first one, is what we call the call premium. Call premium. So for us to be able to recall the old bonds, we have to pay a premium. There's an agreement for the old bond. If you could display this question again, the call premium has been given. But because you are terminating the contract in between, you have to pay with some premium. Look at, we can read the question again. We are told Smooth Drive Limited, a motor vehicle assembly company, issued a 10-year, 16%, shillings 100 million par value bond 5 years ago. The bond was issued at 2% discount, and the issuing cost amounted to 2 million. Due to the decline in treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for refinancing. A finance analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings 100 million par value, 12%, 5-year bond could be issued by the company. Issuing cost for the new bond will be 5% of the par value, and a discount of 3% will have to be given to attract the investor. The old bonds can be redeemed at 10% premium. So the old bonds, ladies and gentlemen, the call premium will be 10% of the entire amount, which is 100 million. So remember, it is 10% of the old bond amount. The old bond was 100 million. So 10% of 100 million in terms of shillings millions What do we have there? 10. So the first mark went those students who were able to calculate the call premium, because this is an amount that you have to pay immediately when you want to terminate the contract, because for you to issue the new bonds, you must terminate the contract. So once you call these people, tell them that this thing of yours is very, first of all, they'll tell you, give us the call premium. So it's an initial outlay amount. And then the other thing, we have the other penalty is what we call the overlapping interest. So mention there, the overlapping interest. The overlapping interest. The overlapping interest. So overlapping interest, ladies and gentlemen, remember, once you have this old bond running, at some point in time, you will have to receive this money, for example, like now 2 months. We have the 2 months here. You receive, ladies and gentlemen, the new issue much earlier, and then you start organizing how you're going to refund the old bondholders. That, of course, refund takes some time. And you're told this time is 2 months. Of course, over the 2 months now, you'll be paying the two interests. So the two interests, this interest here of the old bond, which of course you're not supposed to be paying if you're to pay up immediately upon receiving this new bond here, this will be a penalty for you. And have they given us, in this case, ladies and gentlemen, the overlapping interest there? What they have told us there, if you read the question again, let's read this question separately. If you read the question again, first of all, the old bond, ladies and gentlemen, its interest rate is 16%. The old bond here, the interest which are against now is the old interest. So we have 16% over 100 million. Over 100 million. We are reading this. We are told here, this paragraph, second last paragraph before required, the old bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid on redemption. Ladies and gentlemen, just show them the board here. We have the total interest, 16% of 100. This is the interest for a whole year. But remember, the overlapping interest is interest for how many months? For 2 months. So in this case here, times 2 divided by 12. Times 2 divided by 12. So ladies and gentlemen, could you kindly give us, in this case here, this figure, 16% times 100 times 2 over 12 will give us what figure? So we have 0.16 times 100 times 2 divided by 12. I'm able to get a funny figure, 2 decimal places, 2.67 like that. 2.67 like that. Now, ladies and gentlemen, after that, we are working with this CODI acronym. The next thing, of course, is the discount. Discount. So give us the discount now of the new bond. These two, when we talk of CODI, these two are for the old bond, these two are for the new bond. So give us the discount of the new bond. Discount of the new bond. So if you read this particular question very well, ladies and gentlemen, you'll be able to see where they are giving us terms and conditions of the new bond. Terms and conditions of the new bond. Like if you read from the second paragraph, due to the decline in treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for refinancing. A financial analyst engaged by the company to assess the possibility of financing the debt reports that are new shillings 100 million par value, 12%. 5-year bond could be issued by the company. Issue cost for the new bond will be 5% of the par value. So issue cost here, this I stands for issue cost. So issue cost here will be 5% of the par value. You can see also the new bond is 100. Normally the par values are the same. And then on the same breath, they're telling us 5% of the par and a discount of 3% will have to be given to attract investors. So the discount here will be 3%, ladies and gentlemen, of 100. So 3% of 100 gives me 3, and then we have 5% of 100 giving us what here? 5. Ladies and gentlemen, at the very beginning, for us to attract these investors, we have to offer a discount. This discount, offering of discount is as good as giving somebody money. Because remember, for bonds, later on at the end of the period, you have to return everything. That customer, that investor of yours will not recognize the fact that you gave them some discounts at the beginning. So this discount and issue costs are being incurred at the very beginning. And that is why we are capturing them under cash investment, initial outlay. Initial outlay. So we have here total. So come and give us the total here. Give us the total. So you take 10, which gives us 20 point what here? 20.67 like that. 20.67. 20.67 is the total figure. However, remember at the very beginning, we also stand to receive immediate tax benefits. The tax benefits. So we stand to receive immediate tax benefits. So mention there tax benefits. Tax benefits. The tax benefits. So tax benefits. Which tax benefits are we talking about here? Tax benefits. Number one is the tax benefit on the call premium, because these guys are going immediately. Once I pay them the call premium, I'll go to the taxman and tell the taxman, hey, there's some reimbursement I want. So we have the call premium. How much is the call premium? It is at 10. This 10 qualifies for a waiver. Hey, I incurred some overlapping interest to make this particular transaction. That one I have to recover from the taxman immediately. So we have here the overlapping interest. So overlapping interest, what do we have? Overlapping interest, ladies and gentlemen, overlapping interest is 2.67. Overlapping interest is 2.67. This UU stands for what here? An amortized discount. The first one here is an amortized discount. An amortized discount. The first one is an amortized discount. An amortized discount and an amortized issue. An amortized issue. So, ladies and gentlemen, remember, for taxation purposes, the discount here is supposed to be allowed every year. But now that I've terminated the contract here with the old investors, if there are any discounts we had given them, which in this case here we had not amortized, the taxman will allow us to claim the whole amount at once. So remember, for this unamortized, we are talking of the old, unamortized, old loans, unamortized. Now listen and listen to me very well. Look at the old discount. The old discount. The old discount, what do we have there? The old discount, what do we have there? If you could read that question again. So I'm reading again from the beginning. Smooth Drive Limited, a motor vehicle assembly company, issued a 10-year, 16%, shillings 100 million par value bond 5 years ago. 5 years ago. The bond was issued at 2% discount, and the issuing cost amounted to what year? 2 million. 2 million. Please get me back. 2 million. 2 million. 2 million. Ladies and gentlemen, listen and listen to me very well. 5 years ago, we issued some old bond there. And we are told, especially this thing to do with the issuance cost. The issuance cost, they have given us a figure of what here? 2 million. This issuing cost is 2 million. So 2 million, it means that every year we are supposed to be claiming how much? We are supposed to be amortizing how much? So come and divide this by what here? By 10. Divide that by 10. Now, ladies and gentlemen, this will be the amortized cost per year. And you have been able to consume how many years? 5 years. So we are left with how many years here for the bond to be over? Remember, it was a 10-year-old bond. So in this case here, we have been able to eat 5 years. We have 5 years to go. Here I'm interested in the unamortized. We have 5 years to go. So then I will come on top of 2 divided by 10 times what here somebody times 5 for an amortized issue cost. An amortized issue cost. 5 years remaining. We look forward. So we have here 2 divided by 10 times 5, which will end up giving us what figure here? Which will end up giving us 1. Which will end up giving us 1. Again, let's look at an amortized discount. That at the beginning of this particular project, the old project, we discounted bonds for our investors. And the rate of discount we're given there, if you read the first paragraph, the rate of discount is 2%. So we talk of 2%, 2 divided by 100 times 100, the par value is 100. So I'm able to get a figure of 2 million. This 2 million I'll be allowed to amortize evenly over 10 years. So you need to come and divide this by 10. And then I'll ask myself, given that I've been able to get the discount per annum, what is the remaining useful life? What is the remaining life of the bond? It's a 10 years bond, which was issued 5 years ago. So we have got 5 more years to go ahead. So we are looking at the unamortized component. So come and multiply this with 5, which again gives me what figure? Somebody here gives me 1. So could you kindly give me the total here? Give me the total here. The total will be 10 plus 2.67 plus 2, which gives me 14 point what here? 14.67. I'm only interested in 30% of this. 14.67, I can only get a waiver of 30%. So come and take here the figure you've gotten there times 0.3, I'm getting 4.4. I'm getting 4.4. So once you subtract this 4.40 from this figure, from 20.67, whatever I will get will be my initial outlay. The initial amount which I need for us to be able to redeem for redemption. We need 16 point what here? 27. 16.27. Yes. Or tax is 40%. I would have lost it there. Tax is 40%, sorry for that. So go back a little bit. So you're saying 14.67 times 0.4, which gives me 5 point what here? 87. 5.87. 5.87. So take 20.67 minus answer. That gives me 14 point what here? 80. 14.80. Allow Mwalimu to repeat something here very fast. Yes. Yes.
How did you calculate an amortized discount?
An amortized discount. How do we calculate an amortized discount? First of all, we got the total discount. The total discount of the old bond has been given there, Mary. The total discount of the old bond, they have given us 2%. So it is 2% of the par value. The old bond gave us 100 million, the total loan, 100 million. So 2% of 100 million gave us what here? 2 million shillings. And then remember, we are allowed to amortize this thing evenly over the useful life of the bond. And the bond's useful life is how many years? 10 years. Which gives us what here? 0.2 million per year. Meaning that the first 5 years, I'll have eaten what here? 0.2 times 5 gives me 1. That is amortized, already water under the bridge. And then the remaining will be 1 because the total should be what here? Should be 2. So we are saying, ladies and gentlemen, that out of this total 2 million, the first 5 years we have eaten 1. The unamortized 5 years will eat the other 1 like that. So the most important thing is for you to be able to measure the useful life remaining. We are remaining with 5 years moving forward. So then 5 years and each year should be 0.2. So 0.2 times 5 will end up giving me what here? Will end up giving me 1 like that. Is there any other question before I repeat? I'm going to repeat this. Any other question before I repeat?
You're saying this bond thing looks tough.
The bond thing looks tough.
From Edwin.
From Edwin.
But there's a question. What's the difference between the amortized issue and discount from building.
Okay. Okay. Now, so as I answer that, I would want us to just look at this thing again, once and for all. We understand it. It's not a tough thing. This is the easiest thing. The easiest thing. The bond refinancing is not a tough thing. No, it's an easy thing. It's a very easy thing. Now, the first question, ladies and gentlemen, that I would want us to understand there is what? The first thing that I would want us to understand there, they want us to calculate the initial what? The initial outlay. They want us to give them the initial outlay. So we could repeat the initial outlay. The initial outlay of bond refinancing. Now, ladies and gentlemen, the moment I say I want to refinance a bond, when I say I want to refinance a bond, I want to retire an old bond. I ask these people to return my papers, I give them their money. At that particular exchange between old bonds being returned and new bonds being issued, how much money do I need? I look at the penalties. I'll go to my contract with the old people, with the old investors, look at the kind of penalties we have with them. Of course, they will specify that if you're going to cancel our we're going to cancel our bonds, you must give us what we call a calling premium. You have recalled the bonds. Give us a premium. So the first thing in this initial outlay will always be, remember this, coding, like this. The first one is the call what? The call premium. The call premium. This you have to pay. The call, it's a contractual. Have they given us this note, a note on the call premium? Not on the call premium. Just take us there, take us the question. Call premium. Call premium. What do we have under call premium? Now, ladies and gentlemen, if you read this paragraph on before required, the second last paragraph, before required, the second last paragraph, the old bonds can be redeemed at 10% premium. We start from there. That premium of redemption of the old bond is what we are calling the call what? Premium. So it is 10% of what? It is 10% of 100 million. So as we return this money, the money, we'll be returning the money with 10% on top. So 10% of 100 million gives me what? Yes, somebody gives me 10. That is the first thing. From there we come to this O, coding. O stands for what? Overlapping interest. Overlapping interest. It's a penalty. They normally come together with the premium. They have told us on this particular second paragraph before required, the old bond can be redeemed at 10% premium. And in addition, 2 months interest penalty will have to be paid on redemption. In addition to the whole premium, the overlapping interest has to be paid. So for us to get the overlapping interest of the old bond, we must, ladies and gentlemen, very fast know the rate of interest of the old bonds. At the very beginning, after they gave us the rate of interest, what is the rate of interest in this question? At the very beginning, they gave us 16%. You could show them the board. We have 16% here. So we have 16%. 16% of what, my friends? 16% of 100 million. But remember, this 16% is an annual figure. 16% is an annual figure. And yet the overlapping interest, which is coming in the overlapping period, is for how many months? 2 months. So this has to be prorated. So times 2 over what year? 12. Times 2 over 12. So 16% times 100, we're repeating this together, we have 0.16 times 100 divided by 2. No, not divided by, but times. Times 2 divided by 12. This gives us what figure, somebody here? 2.667. So you can take 2 decimal places, 2.67. Now, ladies and gentlemen, I need to entice these people. For us to entice these people to take up these particular new shares, we are told, new bonds, we are told that there is a discount. So discount of new bonds. It's a cost on you. It's a current cost on you. It's like you are giving them money to take up your bonds. So the discount of the new bonds, please take us back to that question. The discount of the new bond, what do we have there? The discount of the new bond. Now, if you look, this discount of the new bond is given in the second paragraph. Second paragraph. Due to the decline in treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for refinancing. A financial analyst engaged by the company to assess the possibility of refinancing the debt reports that are new shillings 100 million par value, 12%, 5-year bond could be issued by the company. Issuing cost for the new bond will be 5% of the par value, and discount of 3% will have to be given to attract. So the discount, we've been told, is 3%. So 3% of the amount to be borrowed, which is 100 million again for the new bond. So 3% of 100, that gives us what here? Somebody 3. From there, we have the issue cost. Issue cost again of the new bond. Issue cost of the new bond. Issue cost of the new bond they have given as a percentage. Issue cost of the new bond they have given as a percentage. Issue cost of the new bond they have given as a percentage, they have told us it is 5%. Issuing cost for the new bond will be 5%. So we have here 5% again of what here 100, which gives us what here, which gives us 5. So come and give us the total. So the total, what do we have here? Somebody, we have this is 8. So we have 10.67. So total here we have 20.67. And then remember very well that the taxman has got interest in these businesses. The taxman would always want the businesses here to continue. That is why when you borrow, the interest is allowed for taxation purposes. So come and remember to subtract here. So you say less the tax benefits. The tax benefits. And of course, you'll come and look at this. The first thing that this guy will allow you to claim against your incomes will be, for tax purpose, will be the call premium. So call premium, you pick it the way it is. Call premium, no issues at all, 10. It also allows you to pick the overlapping interest the way it is. Overlapping interest the way it is. So overlapping interest, ladies and gentlemen, overlapping interest, what do we have? 2.67. Now, when it comes to discount, you see these are the discount for the new bond. You'll be claiming them slowly moving forward. What the examiner, or rather the taxman, will allow you to claim immediately for discounts and issue costs are the unamortized. So we have here unamortized. We have an amortized discount. And then we have an amortized issue cost. And remember, for the two, we are talking of the old what? We are talking of the old bond. For the two, we are talking of the old bond. We are talking of the old bond. Because you can't talk of unamortized for something that is new, which you are issuing immediately. So unamortized is for the old. Unamortized is for the old. So long as you are able to remember, like those days we were being taught this thing, code like that. This can really guide you. So coding, and then we have code like that. That can really guide you. And remember such things. These are those things that you study almost immediately. When your exams are quite close, you study them the last minute. So you cram them. Students tend to fear them, but I don't really fear them. So the old bond. So we have the unamortized discount. So I'll come and look for the old discount first. So old discount, as we finish this question, ladies and gentlemen, the old discount, has the old discount been given? Please take us back to that question, the old discount. Are you able to see the question? So what have they told us about the old discount? So the old discount were given up there. Smooth Drive Limited, a motor vehicle assembly company, issued a 10-year, 16% shillings, 100 million par value bond 5 years ago. The bond was issued at 2% discount. The old bond was issued at 2%. So 2% of what? Of 100 million, which will end up giving us what? 2 million. But now remember, this is supposed to be amortized over how many years? 10 years. So divide by 10. Since we issued this bond, how many years have lapsed? 5. We are looking at the forward ever. 5 have lapsed, 5 remaining. So we are talking of the 5 which are remaining to help us know the unamortized. So in this case here, for the unamortized, I'll come and take this multiplied by the remaining useful life. You multiply this by the remaining useful life. You get the discount per annum times the remaining useful life. So then this will be 2 million divided by 10. The remaining useful life is 5, which will end up giving us what here, somebody? This is 10 divided by 10. Our figures are in millions. So for the unamortized discount, you're talking of 1 million like that. Now from there again, look for the unamortized issue. Unamortized issue cost. Unamortized issue cost. Unamortized issue cost, what do we have? We are told unamortized issue cost were 2 million for the old bond. So again, issue cost, the old issue cost were 2 million. What I need to know is the issue cost per annum. So you divide this by 10. Again, you're looking at the unamortized period. So come and multiply this by 5. That is how we were able to get this one like that. So then come and add for us. When you add here, what are you going to get? This 12 plus. This gives us 14.67. So this is the amount they'll allow you to claim for tax purposes. Now remember, the benefit will be 40% of this. You take this times the rate. So this is the tax benefit. The tax benefit. The tax benefit is 14.67 times 40%. So we have here 14.67 times 0.4, which will end up giving us 5.87. So 5.87 you subtract, whatever you get there will be your initial outlay. Will be your initial outlay. Initial outlay. So the initial outlay here minus 20.67, which gives us 14.80 like that. The initial outlay is 14.80. By doing that, you will be able to get your marks there. Good marks. Good marks. Any question up to there? We want to get questions. Time is up. No. We can extend a little bit. We just finish this if you give me a few minutes, like 5 to 10 minutes. Because we don't finish this, it means in the next lesson again we start the question afresh, which will be unfair. So can we finish the question? Can we finish it? Most of them are saying we. They're sleeping. Yes, sir. We just finished. We're left with something very small. Very small. Very small. As you do such kind of a class, you should be sipping a cup of coffee. Eh? Don't allow yourself to sleep, really. Don't allow yourself to sleep. We finish, yes. So we go to part 2 of this question. Part 2 of this question, ladies and gentlemen. Part 2 of this question, what are they telling us? Part 2 of this question. They want us to give them the annual cash flow savings, if any, expected from the bond refinancing decisions. So the annual, I hope these figures, you have taken them up, 14.8, I also remember it. Quite interesting. Once I do a second question from this area, we shall be very comfortable. For now, I know there must be a few of us who are seeing nothing, but we shall overcome. You guys are great. Now, so we have got 2 decisions here. Either we remain with the old bonds, or we issue the new bonds. So remember now, these are the annual what? The annual costs. This is Roman 2. The annual costs. Annual costs. So annually, what shall we be paying annually? Ladies and gentlemen, annually, we shall be paying one thing alone, the interest. Annually, we shall be paying the interest. For the old bond, our interest is 16%. The old bond, the interest is 16%. So 16% of 100 give us a figure. 16% of 100, that is 16. How about the new bond? The new bond, ladies and gentlemen, The new bond, if you read the question there very well, the new bond is equivalent, or other was having what interest? The new bond. The new bond, ladies and gentlemen, the new bond there, the new bond there, the new bond is not 10%. The new bond is 12%. The new bond is supposed to be 12%. 12% of the 100, which gives us what here? 12. Now, always in terms of bond refinancing, you remember the tax man. The tax man. So you come and less here the tax benefits. You less the tax benefits. The tax benefits. Of which the very first tax benefit, ladies and gentlemen, which you will enjoy here, is the tax benefit on the interest that you are paying. The tax benefit of what here? The interest there is 16. So we have here tax benefit. The same case, less tax benefit. Next tax benefit, of which the first one will be the interest. The interest here that you will be paying every year normally qualifies for tax purposes. And then the other two things, of course, which qualify are what we call the discount and what here the issue costs. Those two only. So we have discount, and then we have the issue cost. Discount and issue cost. So please take us back to the discount of the old bond. Discount of the old bond as we finish. We'll finish this in less than a minute. Discount from the very beginning up there. The discount of the old bond. The discount of the old bond were given. The bond was issued at 2% discount. So I'll take my calculator. Discount is 2% of 100 million. But remember, this one is to be consumed over how many years? 10 years. And as here we are getting annual costs. And here we are not looking at an amortized or we want cost per annum. So come and divide this by what year? Divide this by 10. Whatever you get, so we have 0.02 times 100. Whatever we get, we divide by 10. So then every year, what the taxman will be giving me every year will be 0.2. So you get the discount because of the annual. How about issue cost? If you ask back to the question, the issue cost, they gave us issue cost. Issue cost, they gave us what figure, somebody? The issue cost, paragraph number 1 of the old bond was 2 million. So again, I will take the 2 million. The taxman will always allow you to amortize evenly. So you divide this by 10. So again, this gives me 0.1, 0.2. So please add for us. When you add for us, what are you able to get here? This gives us 16.4. We just need the tax benefit of this, which will be 40% here. So 40% or 16.4, we have here 16.4 times 0.4, giving us 6.56. So you subtract. Interest you are paying, this is an income to you. You subtract. To get, in this case here, the annual cost. To get the annual cost, you subtract. So we have 16 minus answer, which will end up giving us 9.44 like that. The same, do the same to the new bonds. For the new bonds, ladies and gentlemen, what do I have? Are you able to see the discount for the new bonds? Somebody, discount for the new bonds. Are you able to see the discount for the new bonds? Discount for the new bonds. Discount for the new bonds. Discount for the new bonds. So they've given us there 5-year could be issued by the company. Issuing cost for the new bonds will be 5% of par value. So for the new bonds, we have 5% of the par value, which is 100. But now remember, this particular new bonds, what is the useful life of the bonds? The useful life of the bond is 5 years. It's 5 years. So 5-year bond. The useful life here is 5 years. So you come on top of 0.05 times 100. You divide by the useful life, which is 5, of which I'm able to see a figure of 1. You divide this for your revision, divide by 5 because of the word annual, annualized. So come and give us the issue cost of the new bond, still on the same paragraph, They gave us 3% will have to be given to attract investors. No. For the new bond. For the new bond, we are given here 12%. 5-year bond could be issued by the company. Issuing cost for the new bond will be 5% of the par value. This 5% is issuing cost. The 5%. Discount is 3%. Thank you very much for that. Discount is 3% over 100, but don't forget to divide this by 5. Don't forget to divide that by 5. So we have here 3.03 times 100 divided by 5, which gives us 0.6. Issue costs are the ones which will be 5% over 100 divided by 5, which gives us 1. So please come and add everything. So we have here 12 plus 1.6, giving us 13.6. So the tax benefit will be 40% of this. So times 0.4, which will end up giving us 5.44. So please subtract this from the 12. So 12 minus answer, we have 6.56 like that. Now I can see my annual costs. If I remain with the old bond, I will continue paying 9.444. If I issue the new bond here, I'll be paying 6.56. So I can see the benefit of the new bond. So mention there the benefit of the new bond. Mention there the benefit of the new bond. Benefit of the new bond. Benefit of new bond. The benefit of the new bond will be 9.44 minus 6.56. Benefit of the new bond. 9.44 minus 6.56. Get your calculator. We have 9.44 minus answer, which gives us 2.88, which is an annuity. Every year, that is the benefit we enjoy. An annuity for 5 years. An annuity for 5 years. An annuity for 5 years. So read the question again, read this question again, read the requirement again, read the requirement again, read the requirement again. If you read this requirement, we are told number 2, the annual cash flow savings, this figure. The annual cash flow savings, if any, expected from the bond refinancing decision, that is it. And then number 3, the net present value of the refinancing decisions. So the net present value, what will we do to get net present value? I'll come and take this 2.88 because it's an annuity. I multiply it with the PV minus the initial outlay, minus the initial outlay, minus the initial outlay. Fortunately for the initial outlay, we are down the initial outlay in part 1 above. And we got a figure of 14 point something. Who can remember that initial outlay figure, somebody? The initial outlay figure. Who can remember the initial outlay figure? 14.8. I'm being told this initial outlay figure is 14.8. Now, ladies and gentlemen, I know that this PVFA will be a PV for how many years? 5 years. But what shall we use as our cost of capital to discount it? What shall we use as our cost of capital to discount this figure? Should we use 10%? Should we use 12%? 16%? What do you think shall we use for us? What do you think shall we use as our discounting rate? What shall we use as our discounting rate? 7. Most of them are saying 7%, isn't it? Yeah, because if you go back to the, please go back to the question. 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 If you go back to the question, you'll be able to see the last paragraph before required. The applicable corporation tax rate is 40%, and the after-tax cost of debt to the company is approximately 7%. Here we shall use the after-tax cost of debt as our discounting. As our discounting, ladies and gentlemen, because we don't have the discounting rate, because we don't have cost of equity. Here we are talking of interest. If you remember, WACC, weight of equity, cost of equity, weight of debt cost. So here we have got nothing to do with the equity. So you can only make use of what here? KD. KD after tax, they have given us a 7%. KD after tax is 7%. KD after tax is 7%. Is 7%. And remember, in most cases, the examiners will not give you that 7%. They'll expect you to know that the cost of capital will be the interest rate of the new bond times, in this case here, 1 minus tax. It will be 12% times 1 minus 0.4, which will be 12% times 0.7, which at the end of the day will give you what here? 7.2, approximately 7%. So I want to see whether there is any student who will be able to give me this PV far as we go to sleep. As we go to sleep, this PV far, ladies and gentlemen, remember the formula of PV far. It is 1 minus 1 plus R raised to negative n, everything to be divided by R. This is the formula of PV far. So PV